Welcome to Convince Me in 15 Minutes, where we give our guests 15 minutes to convince us about timely topics in the financial services industry. Before we begin, please subscribe below. The Convince Me in 15 Minutes podcast will introduce you to new concepts, theories, philosophies, and practices in the financial services industry. Your guides are Luke Tawas and Keith Thompson. We'll follow up the initial presentation with questions. So again, subscribe below and we'll introduce our guest speaker.
I'm here today to convince you that multifamily real estate is a great asset to add to your investment strategy in a well-balanced portfolio. You know, all commercial real estate isn't the same. The biggest difference being multifamily real estate is considered the lowest risk asset class or segment in commercial real estate. The demand drivers in multifamily are really set by a systemic housing shortage, and the demand long-term has and will be quite a bit more than the supply. So we like the stability of the multifamily sector. And over the years, we've owned everything from office to retail, storage units, car washes, and we have found that multifamily is the most consistent performer of any asset class we've ever owned, which is why we chose to make it our focus going forward. Multifamily has, probably because of the risk profile, is able to acquire or get better debt terms in the marketplace than other commercial real estate sectors. And it's really the risk is measured because of the lease terms. So we have anywhere from 9 to 15 month lease terms. So whether it's a good economic time or if it's a challenging market condition, we can adjust very quickly as we're turning leases over within at least a 15-month window, and we can lower rents and raise rents as needed in the marketplace to be able to hit our occupancy expectations. Makes it very, very flexible within the multifamily sector. We'd like to compare multifamily real estate specifically to the public markets and show what the return threshold or the return alpha is over a long period of time. And when you look at investing $100,000 in 2004 into the S&P 500 and into multifamily real estate, the value is much greater over that time period, and the volatility is considerably less than the public markets. You want to own commercial real estate in your portfolio because it is a low correlation to the publicly traded markets. Multifamily specifically has the ability to generate really consistent cash flow, providing good annual yield, and your income grows and appreciates along with your asset or your capital appreciation, it is a hedge against inflation. So as inflation rises, so do rents along with it, and that's a real benefit. And the tax benefits are really probably one of the greatest last tax benefits that are out there from how income is treated. That's very beneficial in our industry. So just when you're looking at investing in commercial real estate, key is finding the best manager. And what we have put together with our program at Ackermann Group, we have found that the vertically integrated structure from a manager who really handles every aspect of the investment cycle is key in being able to make a great impact and generate value over time. Along with that, I think it's important that the manager is investing heavily alongside of the investors. That gives them some skin in the game and really holds their feet to the fire on succeeding on their business plan. Renovation is one strategy that some managers choose to use on a value add strategy. The renovation, it's like what you see on TV flipping homes. It's all about the schedule and the time from when you close to when you can generate the additional value. And the shorter you can make that period through the renovation process, the more beneficial to the overall return that you'll receive. Taking care of your properties, we have the philosophy that if you take care of your properties will take care of you, and that's been proven over the decades for us. really taking a long-term look at the capital renovation or the capital improvements at the property, whether it's an asphalt overlay or a roof replacement. You want to be able to fund for that ahead of time so that when you get 10 years down the road or 5 years down the road and need a new roof, you're not pulling too much cash flow to replace that roof. You have already funded for that roof. So that's very important in planning ahead. And then the debt structure is key. We're seeing that today with a lot of high leverage floating rate buyers in the marketplace who are right now boxed into a corner, and a lot of them are probably going to lose their properties to the bank because they can no longer afford the monthly payments on the floating rate loan. So really having a very consistent and strong debt strategy is key to long-term success in our industry. We're in an interesting investment cycle here. It's a new cycle, I'd say, since after the great financial crisis in 2009-10, where we are seeing higher housing costs. So the cost to own a home and the cost to rent a home have really varied and diverged greatly. So it's almost 2 times more right now to own a home than it would be to rent an apartment. So we're seeing a lot of the first-time homeowners and a lot of others that would typically buy a home but don't see the value in that today are continuing to rent longer. We're also seeing the demographic that is interested in renting because it's a lifestyle choice. They choose to rent because they want the flexibility. So it's really pushed demand in our space due to the housing costs. A couple stats here. The median U.S. Housing price hit a record level this year, 6 times the median U.S. income. That's the largest we've ever seen in over 50 years. And over this period, on the chart here from 2012 to 2023, we have rents have grown 7% annually. Well, that's over the past 5 years. I'm sorry, 7% annually over the past 5 years, compared to housing, which has grown 20% annually over the past 5 years. So big difference there. Really pushing more demand into the apartment sector. What we're coming up on here is the largest loan maturity rate we have seen in almost 20 years. Actually, historically, I don't know that we've ever seen this many loan maturities coming due in a couple of year period, and that's going to create a lot of transaction volume for us in the marketplace. We're going to be out in finding good quality assets. That coupled with the other market conditions, and we can go to the next slide here, Luke. The other market conditions being a large influx of product coming into the marketplace. We have a lot of new product coming into the marketplace. The highest level, again, I think historically that we've ever seen, over 1 million units in the last 2 years. And that is pushing down occupancy and rent growth. So we're seeing values come down, and we're estimating somewhere in the 20% range by the end of this year. We saw about 7% last year. We think we're going to see another 10 to 12% this year, and we'll be seeing some of the best cost basis that we have seen in my 18 to 20 years in this industry. I mentioned highly leveraged floating rate loan buyers. That is the distress in the system right now, and that distress is going to become more apparent over the next several months and into the second half of this year. And there will be opportunities to buy that distressed. But whether you're buying distressed or whether you're buying the stabilized assets that are just coming due on a 15-year mortgage or a 10-year mortgage, those owners have already created a ton of value. And coming into this higher interest rate market, it just doesn't make sense for them to refinance. So again, a lot of product coming to the market here in the next year and a half, creating a lot of opportunity for investment managers with dry powder. We talked about the housing shortage. You can see here, really, Freddie Mac estimates somewhere in the range of 145 million units are needed to meet the demand today, implying a shortage of about 308 million units. The rate that we're building today, and we've had a very sizable increase in construction over really with the COVID demand, and we're still not building enough to meet the annual need to climb out of this systemic housing shortage. Now, I can't see it. The numbers don't show you that 20 years from now potentially meeting demand at these rates. And with the higher interest rates, construction has really plummeted, and so we're seeing very little new housing starts today as the market rates are just too high to be able to build and get a return out of these deals. So we believe that the target markets where you can achieve the best yield and long-term returns is secondary Southeast and Midwest markets. Now, secondary markets in general have outperformed the national average over the last several years, and these are markets that fly a little bit under the radar. They're typically overlooked by larger institutional investors, so there's less competition. You can get a little bit higher yield out of the gate, and there's some really compelling growth drivers from an employment standpoint, population growth standpoint, and lifestyle standpoint when you look at a Charlotte, a Raleigh, a Greenville, Knoxville, even Columbus and Indianapolis have been really just growth markets in our region here. We like these markets for a couple of reasons, and I'll show you why secondary markets are really compelling. When you look at apartment performance, jobs are key in everything that we do. You want to see decent job growth, and supply is also very important. We're seeing a glut of supply in some of the markets that saw the highest immigration during COVID, and those population surges brought developers along behind them and are seeing the largest supply growth in those markets, and there's an imbalance of supply and demand. Well, what we like here, if you go two lines up in this chart from the bottom, you've got jobs to deliveries. This is a ratio in Knoxville, Tennessee. They're creating almost 7 jobs for every 1 housing unit being delivered into that marketplace. Chattanooga's 3. We've got Cincinnati at 3. Indianapolis, 4.5 jobs for every one housing unit. So we like to see these markets. You can see Columbus, which has actually been a growth market, and they're seeing a lot of new inventory in that market. That's probably where some of our largest holdings are. The bulk of our portfolio is in Columbus, and we're going to see softening in rents, and we have been occupancy and rents for the next year, maybe 18 months. But as that new stock fills up, which it will, because this growth is rapid there from a population standpoint, that will balance out, and occupancy will return and rent growth will return to more historic levels. So that's a big metric for us. New jobs to deliveries. We like to be in affordable markets as well. We're a B class operator. And so we want to see rent to median income ratios around 20% to try to stay well below the national average. And then cap rates, as I mentioned, the statistics tell us that these secondary markets, you can get a little bit better cap rate going in, a little bit better yield. And I believe that's due to a little bit less competition from some of the bigger institutional buyers. So that is probably only 10 minutes. I don't know if that hits some of it. We could go back to a couple other slides, but I think in wrapping up, it really is it's a supply and demand story in multifamily. It is a sector that everybody needs a home. So when you look at long-term demand in any sector, multifamily has a very strong story for stability into the future.
Great. Well, thank you very much, Chris. This is the part of the show where we just ask people to thumbs up if they agree with you that, multifamily housing is a wonderful, provides a wonderful opportunity. It's a great place to invest. So, we really appreciate your time. Keith and I are going to ask you a couple questions, if that's okay. One of the things that you mentioned is cap rates. Can you just kind of go into what goes into a cap rate? Is it just if you have a cap rate of 5.2%, does that mean for every 100,000 you're spending on real estate, you're getting $5,200 a year in income, or is there more to it in calculating a cap rate for those that don't know?
No, it's pretty simple. It is a measurement of your net operating income. You have to be careful. We use it more as a gut check. We really look at annual cash on cash return and total return in our underwriting to determine if an investment works for us and meets our criteria. Because cap rate can be calculated either before capital expenses or after capital expenses and what's in capital expenses. So it can be a varying metric. But yes, it is a measurement of the value and your net operating income. So you can reverse it to get to your value, or you can take the cap rate and the value to get to a net operating income number that justifies.
Great. And then on that $5,000 a year roughly that you get an income for every 100,000 that you're spending, like, can you give us an example of the tax savings that you as a real estate investor can provide to the end user?
Yeah. So I am not a CPA. We have some folks here that do better at that than I do, but the general gist of it is that you can depreciate an apartment building over, I believe it's 37 years. So you can utilize that depreciation to offset your income in the form of passive losses. So you use the depreciation, and there's some offsetting expenses as well that you can utilize to offset the net income at the end of the day. And so you could receive in the first couple of years of an investment $5,200 a year and pay zero tax on that. That will eventually come back around when you sell the asset, and it will the tax will catch up to you, but it's in the form of a capital gains tax, not ordinary income, which is what it would be taxed at today. And then we've started using cost segregation studies. We use a third party to do this. They're very involved, very intricate. They go in and they take what we would typically depreciate in the building and some of the personal property. They go in and they look at every light switch, every electrical plate, and they drill down to the minutia of every building part that can be depreciated, capturing significantly more early accelerated depreciation. I want to say we were able to depreciate 30% more than we were before doing the cost seg studies now with the cost seg studies. So that it really allows you to accelerate a lot of that depreciation in case tax laws change down the road. You've captured a lot of it today.
I was going to say, from an actual investment standpoint, I think the layperson looks at kind of real estate as homogenous, and real estate's either doing well, it's doing lousy, or it's kind of been flat. And obviously, the past 4 or 5 years, it's been going through the roof. But even when you look at these different markets that you're kind of going after here, they're not even all created equal. And I just this week, I was traveling to some of the ones that you mentioned, Greenville, Raleigh, Charlotte. And when I wandered around those 3 cities, I will tell you, it just looked like there was a crane every other corner building something. At what point in time do these markets kind of become saturated?
That's a great question. We go through this process annually, where we take about 30 to 50 markets in our regions, and we look at all the statistics to see where we are from a supply-demand standpoint. So Greenville is a great example, and I think Knoxville is probably 5 years behind Greenville. Greenville today it's growing like a weed, and it has been for almost a decade. But they have been able to manage that growth. They have not oversupplied, and it has stayed a very stable market. You're not going to see huge rent growth outside of your typical historical, 5 to 6%, 4 to 6%, because they've kept it manageable. But you're also not going to see negative rent growth because there's too much supply coming in. It's a really interesting market, a lot of job growth, a lot of population growth. when you look at a Knoxville, I say they're about 5 years behind because they are nobody's building new right now. I mean, there may be a few projects in Knoxville, but it's very, very little compared to a Greenville or a Columbus. And Chattanooga is probably 5 years behind Knoxville. So these markets are going to get more popular because they have the lifestyle amenities that people want. They have college, university, or state, a lot of state job employment in these markets, and those are key foundations, along with large hospital networks. Those are key foundations for a stable employment base in any market. It just can't make sense of the cost today and interest rates to build new.
So you look at this, I'm looking at the data here for Knoxville, and you've got, what is it, almost 7 new jobs for every 1 unit that's being built.
Yeah.
Is that correct?
Yeah.
All right. So,
and that's total housing for sale and for rent.
Okay. So that includes standalone homes.
Yes.
So if I'm moving to Knoxville, do I have no place to live? Is that?
It is. That's an interesting dilemma because some of these markets will, if they don't keep up, people will stop looking there because they can't find housing or it gets way too expensive. But if you look at the rent to median income, that balances it out. Right now Knoxville's at 22% rent to median income. I want to say, I think we have on here 23% for the U.S. average. I've seen it as high as 30% on the U.S. average. And when you get to some of the larger metro areas, it's as high as 40 or 50%. So
I'm going to go back to an earlier slide, Chris, see if I can find it here, which is this slide, which is kind of what you touched on in regards to the apartment rent versus new mortgage payments. I mean, the difference between those two is the higher home prices and higher interest rates have a multiplier effect where it's basically, the two lines have separated like never before. Yeah. How come rents haven't grown faster then?
Well, I think what we're seeing, if you look at, average long-term rent growth is somewhere in the 3 to 5% range, depending on the markets. I think if you just do a very generic search on ChatGPT, you're going to get 3% long-term. So 7% is pretty good rent growth relative when you look over the long term. And even in 2021, we, across the country, we were seeing 9 and 10% rent growth over that average. We saw in some of our markets, we'd never seen anything over 3 or 4, and we were seeing 9 and 10. So we have seen spikes of significant rent growth over the years, nothing like we saw with COVID. But I think, again, that the housing cost has, because of higher interest rates and nobody's selling, has just exponentially exploded from a value standpoint.
So you think if interest rates come down, people are be more inclined to maybe move on or downsize or upsize, depending on where they are in their life cycle. But for the time being, it's just this kind of roadblock to activity.
Yeah. When you talk to someone who's in the mortgage industry, or you talk to someone who's in the residential brokerage industry, they're not doing much right now because it just doesn't make sense to take out a new mortgage at north of 7%. Unless you have to.
And that really is the biggest difference between homes and apartment buildings and owning those, right, Chris? Where if somebody buys a home, typically either they're buying cash or they're financing it over 15 to 30 years, where with multifamily housing, I think the chart on the right, what that's showing is that there's going to be a lot of properties coming due because those mortgages aren't fixed.
Yeah, so the chart on the right shows that is the number of loans in the multifamily industries. There's 4.7 trillion commercial loans. We have about, the multifamily space has about 35% of that. And what we saw and we were a part of this from right after, I guess, 2012, 2011, 12 was really when things started recovering after the 08 crash. And from 12 to 19, there was just a surge of activity in the industry. Cap rates were coming down. There was a ton of capital in multifamily trying to buy. Office was the more latter sector to really take a hit. So a lot of office owners who were trying to put capital to work were getting into multifamily. Prior to that, it was retail and hotel. Those guys all looked at multifamily. So there was a lot of competition in the multifamily space, and a ton of new mortgages were originated in 2013, 14, 15, 16, and that's what we're seeing come due. These are mortgages that balloon. You can't extend it. You either have to refi or sell. And it's an interesting statistic, the long-term leases and the instability of rent growth in that sector.
So, Chris, somebody like myself that's an individual investor, if they want to invest in an apartment building, you've got to have a lot of money. I mean, can you explain kind of your most recent property maybe that you acquired, kind of the dollars you're talking about, and how does an individual investor get involved?
Yeah, so we're typically buying institutional scale, so 250 or more units, fully amenitized apartment communities. So they have a leasing center, a clubhouse, they have swimming pools and fitness centers. Generally we're buying about $2.5 to $3 million of annual revenue in these small businesses. That's how we look at it. And then we staff it with anywhere from 4 to 8 to 10 site people, a manager who's managing this small business as their own, and then we have a sales team and we have a maintenance team at each property. So these are really insulated communities. We get to know the residents. We take care of them. We provide customer service. We have community events. There's a lot of programming that goes on to promote. Really, we want to promote renewals. We want our residents to stick around for a couple of years because it's very costly when they move out. So we're basically our average acquisition cost is probably in the range of $30 to $40 million for 250, 300 units in a Class A market. We're buying B class properties, some C, and we're fixing them up. And we bring in investors. So our structure is a closed-end fund. We're right now raising a $200 million fund that will close out by March of next year. And $250,000 is our minimum investment. So you can get in and own a piece of that fund, and you'll receive the benefits of the cash flows and the depreciation for your pro rata share. And I had mentioned earlier, one of the key, you're looking for a good manager, one of the key pieces is how much are they putting into the game alongside you. And what we really feel strongly about here is having cash in a position that is treated identical to our investors. And that's really important for us to really balance out the interests, the aligned interests in these investments.
So, Chris, you mentioned for something like this, an investor would have to have $250,000. How does that work once they put their $250,000 in? Is that something that generates income right away? Does it at some point in time generate income? Walk us through kind of the life cycle.
Yeah. So if an investor comes to us they have to go through a process of accreditation. But once they're accredited and they're approved to be accredited, we can get them in. And depending on where we are in the fundraise cycle, we're going to call their capital. It could be all of it at once. It could be a portion of it, but we're really good at being transparent in communicating with our investors and saying, here's what the expectation should be before we sign a commitment with them. But when their $250,000 or their capital goes into the investment, we call that capital. It starts generating an 8% preferred return. So 8% annually is our preferred return. So we have to pay back our investors. Our goal to pay back our investors all their capital plus 8% annually for every year it takes us to get that capital back to the investors. Now that we have actually achieved closer to an 11%, 10% annual cash on cash return and a 19% total net IRR to our investors. So we have greatly exceeded what the preferred return is, which is great because the general partner does share in some of that upside beyond that preferred return. But they put their capital in. Within usually the first year of that capital being at work, they're going to see a distribution check from the fund. We've had a really good history of between usually 6 and 9 months after the first capital coming in. You'll see distributions start, and they stay pretty consistent every quarter going forward. We have a couple tools in our toolbox that can create liquidity events. So there are certain periods throughout the investment cycle where there might be a liquidity event, and we can distribute a little bit more than the typical distribution. And then the market fluctuations from year to year do play into that. Right now we're seeing a little bit lower occupancy and rent because of a lot of the new supply coming into the market, and that'll shrink the returns a little bit on an annual basis. But typically they're staying pretty stable and growing annually. As we start liquidating investments, and in Fund 2 here, we plan to buy somewhere between 8 and 12 properties with the $200 million. And as we start to sell those, that again will be generating larger sums of cash, and we'll be distributing that out to the investors so that we can get all of their capital back and pay them an 8% annual coupon on their investment. Once we've achieved that, then the general partner will start sharing in the cash flows going forward at a 20% rate. So the investors then, once they've got all their capital back plus 8% every year, then they will start receiving 80% of the cash flows, and the general partner will receive 20. And it goes on from there. Generally, we see that occur near the end of the investment as we're liquidating assets. We have to generate a lot of cash flow to get you that coupon of 8% every year plus your $250,000 back.
If I'm following the money, you're looking to raise $250 million. You have a bunch of people that put $250,000 into it. Once you've accumulated enough money, you can go and look to buy a property, correct? A B or a B plus property. At that point in time, you use that money, and does it start generating income at that point? Is that the story?
Yeah, we're buying stabilized cash flowing assets. So we're not buying burned out buildings that have no occupancy or that we have to kick everybody out up to do renovations. We actually go through on our value add strategy. So if we buy 8 properties in this fund, 4 of those ideally are going to be value add. 4 of those are going to be core plus. And really the only difference is the value add takes a lot more capital because you're going in and renovating units. And we have a strategy that we go in and we can renovate occupied units with our general contractor that we've used. We've done this across thousands and thousands of units. And we show up and with a lot of communication with the residents in advance. They've packed up their kitchens and bathrooms. We come in, we ask them to leave at 6 in the morning. We go in and we tear out their kitchens and bathrooms. We replace all the lighting, all the flooring, all the cabinets, countertops, appliances, sinks, plumbing fixtures, mirrors, all of it, so that when they come home at 6 o'clock at night, they have a new kitchen and a new bathroom, new lighting, new flooring in those areas. And they don't have to pay anything more until their lease comes due, and then there is a rent premium for that renovation that's been completed. So it is, as I mentioned, the timing of these value adds is crucial. You want to get to that rent premium as quickly as you can, and so doing this in occupied units in a very orderly and structured manner allows you to take what can take a year and a half and shrink it down to 4 to 6 months.
Well, thank you so very much for being so generous with your time today. I know we've learned a lot, and hopefully our listeners will learn a lot as it relates to investing in multifamily, and obviously how that's distinctly different than a lot of other investing they may have done over their careers. So thank you again for taking the time. Have a wonderful day.
Yes, thank you very much, Chris.
Yeah.